When we picture the economy's money supply, we imagine a giant vault somewhere, filled to the ceiling with mountains of physical cash and gold coins. But physical bills and coins make up a tiny fraction of the economy. The vast majority of modern money doesn't have a physical form at all. It exists entirely as digital pixels on bank screens. Because most money is digital, economists don't measure it by weighing it or counting how much space it takes up. Instead, they measure its liquidity, which is simply how easily that money flows from one person to another, almost like water. Thinking of money as a solid pile is what trips most people up. If you want to understand how our financial system actually works, you have to picture it as a massive flowing water network. At the center of this network is the Federal Reserve, acting as the city's master water engineers. To keep track of all this flowing currency, these engineers check three specific gauges. They call them M0, M1, and M2. The M simply stands for money, and the number tells you how far that water has traveled away from the central source and out into the broader city. By watching these three gauges, the Federal Reserve can figure out exactly what the economy needs, whether the system is drying up and needs more flow, or if it's overflowing and about to flood. Let's start at the source, M0, which economists call base money. Imagine this as the main high-powered reservoir of the whole system. This reservoir holds two things. First, it holds all the physical bills and coins currently moving around in people's wallets and cash registers. Second, it holds digital money that private banks keep parked directly in accounts at the Federal Reserve. These are called bank reserves. This massive central reservoir is the only part of the entire water system that the Federal Reserve directly controls. If they want to increase the overall water supply, they can literally create new digital money and add it right into this M0 tank. But there's a catch. Water sitting in a central reservoir doesn't do anyone any good on its own. It's pure potential. To actually reach average citizens and businesses, that water has to move. That movement brings us to our second gauge, M1, or transaction money. If M0 is the reservoir, M1 is the active plumbing system running right into your house. This diagram shows the connected system. M1 holds cash and checking accounts actively flowing daily. M1 pipes branch into M2 storage tanks, representing savings. To spend M2, you twist a valve, transferring funds back into the active M1 flow. There is a specific mechanism that makes all of this flow possible. The Federal Reserve doesn't pump water into the active pipes. Everyday banks do that, and they do it by making loans. When a customer gets a mortgage or business loan, the bank creates new digital deposits for them. That simple action is what pulls water out of the reservoir and pushes it into the M1 checking accounts. The Federal Reserve can fill the central tank as high as they want, but they are completely dependent on local banks making loans to distribute that flow to the rest of us. Keeping those pipes perfectly pressurized is difficult. If banks pump too much water into the active checking accounts, you get a flood. More money chases the same amount of stuff, and prices for everyday goods go up. That's inflation. This explains a massive economic mystery from 2008. During the financial crisis, the Federal Reserve created trillions of dollars and poured it straight into the central M0 reservoir. Everyone expected massive inflation, but it stayed near 2%. The expected inflation never arrived, simply because the banking system was utterly terrified. The economy was crashing, so banks completely stopped making loans to customers. They clamped the pipes shut. All of that newly created water just sat dormant inside the bank's digital reserve accounts at the Fed. Filling up the central reservoir doesn't cause a flood if the local banks refuse to turn on the taps. If the money doesn't flow, prices don't rise. Compare that to 2021. Instead of filling the bank reserves, the government sent checks directly to consumers' mailboxes. This bypassed the banks entirely. The money skipped the central reservoir and was piped directly into everyone's active M1 checking accounts and M2 savings tanks. Because all this new water instantly entered the real economy and people immediately started spending it, it circulated incredibly quickly. The pipes completely overflowed, and we saw inflation hit 9%. As this diagram illustrates, it all comes down to where the water is. M0 is the central reservoir, M1 is the active plumbing, and M2 is the local storage tanks. The next time you see a headline about the Federal Reserve printing money, you don't have to guess what happens next. You just have to check which gauge the money is actually reaching.